Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, May 22nd, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro event is NVIDIA earnings and the Fed minutes must justify recent Goldilocks price action. So the nuance there is NVIDIA reports after the close today. Elsewhere at 2 p.m. today, the minutes from the latest FOMC meeting will help investors determine the level of consensus among committee members in powering ahead with monetary easing, despite inflation being significantly higher than their stated price stability target of 2%. Lastly, the UK's April CPI data surprised to the upside on both the headline and core basis. In terms of market implications, NVIDIA's earnings releases have replaced quarterly updates from the likes of Apple, Microsoft, Tesla, JP Morgan, and Caterpillar, among others, in becoming the macro bellwether of earnings season. NVIDIA sales are expected to grow 243% year over year, which is the kind of investors need to see to justify a stock up 93% year to date through May and up 205% year over year. One thing that is contributing to that bumpiness in returning inflation back to target in the UK and other major economies is the significant degree to which monetary easing has been priced into forward rate curves. Those expectations have eased financial conditions by inflating the prices of assets and lowering the cost of borrowing for the public and private sectors. Fiscal dominance is a global phenomenon. So as always, we'll wrap up visiting our 42 Macro client dashboard here, as always, wrapping up with a question from our community. This one's about the active passive context. It says, hi, Darius. Thanks always for your tireless processing of global markets on our behalf. You have no idea how much time you save me. Thank you for that kind feedback, sir. Just wanted to query this snippet from today's leadoff morning note, please. The quote is, active management will become increasingly required to perform well amid an era of publicly sponsored winners and losers. Does active here mean the need to engage managers that engage in active investment selection? Are you referring to being active in terms of the asset allocation process, i.e. KISS, our KISS portfolio construction process, or could we be going back to factor style selections again? Sorry to be pedantic. I wanted to make sure I understand the context as intended. So this is a great question. Really helps us unpack some of the elements of our process here. So I'll start by saying the need to be active in this era starts from the fact that we have structurally elevated inflation, and as a function of that structurally elevated inflation, we have structurally elevated interest. Well, I mean, not structurally, but certainly cyclically elevated interest rates. We also have two factors that are calling capital, that are a significant demand on capital on the global capital base relative to where we were for the past few decades, which is the development and deployment of AI, and also the decarbonization of the green energy sector. In fact, there's also three. There's deglobalization as well. So you have AI, deglobalization, and decarbonization, and all those three things are creating a higher demand for capital relative to the existing stock of savings out there. And so you could have some issues with liquidity here and there, particularly when the public sector gets involved in picking these winners and losers. And so ultimately what that means is that asset markets are probably going to be more cyclical. The amplitude of those cycles is probably going to be more extended, and the spread and dispersion between winners and losers is likely to be greater because you're going to have public sector tailwinds for the winners and public sector headwinds for the losers from a regulatory and divestment perspective. So all that means is that active is probably going to do better than what we've all been used to for the past 10 to 15 years, especially the 10 years following the global financial crisis, which is, passive, just passive QE, passive QE, passive number go up QE. That's no longer it's unlikely to be the case here in this fourth turning regime and in this era of increased capital demand and perhaps even capital scarcity if central banks aren't paying attention and asleep at the wheel. So the reality is, if you don't have that kind of persistent uptrend in markets from QE and then just persistently easy monetary policy, then what's likely to happen is that you need something or someone, whether it be machine like our KISS portfolio construction process is guided by in terms of the systematic elements of that trend following process, or whether it be humans and human intellect in terms of picking winners and losers from an individual stock or factor basis. They both satisfy the need to get your portfolio kind of divested from, just sort of this era of easy money that we've exited from, we would argue kind of in 2022. So that's kind of a long-winded answer to say that passive is likely to outperform, generally speaking, relative to passive over the coming decade, just based on all those factors we identified. And as a function of that, you would do well as an investor to either incorporate trend following elements into your passive investment strategy, which is what KISS is. KISS is a passive investment strategy that has trend following overlays to help investors maximize upside capture in bull markets and minimize downside capture in bear markets. And it does that with, very low cost passive vehicles. It only uses 3 ETFs, the SPY, the AG, and the FBTC for Bitcoin. And so we think that's a phenomenal solution we built for our retail investor clients to stay on the right side of market risk and do what they should be doing, which is retiring on time and comfortably. And then at the end of the day, that's what we think the average retail investor's strategic investment objectives should be, and KISS certainly satisfies that need. So we'll wrap it up there. Darius Dale presenting our macro minute for Wednesday, May 22nd, 2024. Everyone have a wonderful day out there. Best of luck, and we'll catch you back here tomorrow. Cheers.